The economy had to face something even worse today, the prospect of a slide back into recession, a so-called double dip. Growth figures published today showed that the 16 countries which are members of the euro have barely had any growth at all in the last quarter. Our economics editor Paul Mason is here to explain this latest economic cloud. Paul.
Gavin, the words double dip are being whispered across the trading floors today. That's because those Eurozone figures, the growth figures, are a clear sign that the stimulus packages have not yet produced a recovery that is self-sustaining. Where there is growth at all, it is mainly down to policy.
The main differences are policy and competitiveness. We've seen some variations in the growth rates in Germany and France, depending on when the impact of their car scrappage schemes have come through in particular. But the main difference, and taking away the bumpiness, but just focusing on the general trend and why some countries are going to have a weaker recovery, are very much to do with competitiveness. Countries like Greece and Spain and Portugal and Ireland, which have had higher inflation and higher wage growth, have found it much more difficult to take advantage of an export-led recovery on the back of some global growth than countries like Germany have.
So let's break down these figures. For the 16 Eurozone countries, it was just 0.1% growth, but you've got Germany at 0 growth, Italy minus 0.2, Spain minus 0.1, offset by France at 0.6 growth. But the detailed figures show a lot of this was down to car scrappage schemes. Overall, the Eurozone shrank 4% year on year. Now, you can see the danger of a double dip in today's Euro industrial production figures. Here's the graph. It's up and then down like an Olympic ski jump. And though it's turned up again at the bottom, that's now fallen back. This slowdown will make it harder for countries to do austerity because it's a fragile recovery and early withdrawal of stimulus could kill it off. Last night's deal to bolster Greece's national debt seems to have bought time. But tonight, the Greek PM, having welcomed it in Brussels, went on TV in Athens to denounce it. As for Britain, there are all kinds of nasty implications of our biggest market stalling and its currency sliding.
I think there will be implications for the UK. The euro area is the UK's most important export market, so if we are looking at a weaker growth outlook in the eurozone, the UK will be affected. If the currency continues to move towards a weaker euro, the UK won't look quite as competitive as it did, for instance, a few months ago. And if the market remains concerned about sovereign risk and starts to shift its focus away from the eurozone to countries with larger budget deficits, then that could start to impact not just on the UK, but on the US as well.
And let's remember, the ultimate weak recovery story is the one that's going on in Britain. This country barely grew in Q4. If we're growing now, most early indicators say it is again barely.
Thanks, Paul. Now, in some ways, what follows